In 1929, the stock market didn't simply correct. It fell off a cliff. Over 3 brutal years, U.S. stocks lost 89% of their value. 1 in 4 workers was unemployed. Banks vanished overnight, taking life savings with them. For many families, the 1920s boom never truly returned. It took a full quarter-century for the market to claw its way back to its 1929 peak. Almost 80 years later, the story seemed to repeat itself with a modern twist. In 2008, it wasn't ticker tape and bucket shops. It was suburban houses and mortgage-backed securities. The housing market cracked. Wall Street's engineered products detonated, and the Great Recession began. Stocks dropped 57% in just a year and a half. Unemployment hit 10%. Banks had to be rescued by taxpayers. 401ks turned into 201ks. And again, it took more than 5 years just to get back to even. Those 2 crashes are burned into the American memory. They are the benchmarks of financial disaster. But the uncomfortable truth is this: the setup going into 2025 doesn't just rhyme with those eras, it stacks their vulnerabilities on top of each other. In 1929, stocks crashed. In 2008, housing crashed. In 2025 and 2026, the warning signs say stocks, housing, and bonds are all at risk together. For the first time in modern history, the entire financial landscape looks like one giant interconnected bubble. This is what some financial historians now call the everything bubble. It sounds dramatic, but the idea is simple. In past crises, investors always had somewhere to hide. When stocks imploded in 1929, government bonds were a lifeline. When mortgages blew up in 2008, central banks could slash rates to zero, flood the system with money, and engines slowly turned back on. But today, the safety valves that saved us then are already wide open and barely working. Imagine standing on a burning ship, knowing that the lifeboats are already full of holes. That's the uncomfortable position the global economy is drifting toward. The Federal Reserve cannot simply cut interest rates down from 5% or 6% to zero like it did in 2008. We're already in a world of structurally lower rates, and the last time they pushed too low for too long, they lit the fuse for the current bubbles. They can't print trillions of new dollars without consequence. They already did that between 2020 and 2022, and the result was the worst inflation spike in 40 years. And a federal government sitting on roughly $36 trillion of debt cannot promise unlimited new bailouts without raising the question, who is going to bail out the bailer? So when analysts talk about a crash window between late 2025 and mid-2026, they're not reading tea leaves, they're doing math. To understand why, you have to stop thinking of this as one bubble and start seeing 3. The first is the stock market. On the surface, it looks like a triumph. Indexes at or near all-time highs. Financial TV filled with optimism. Headlines about trillion-dollar companies changing the world with artificial intelligence. But under the surface, the numbers are stretched to levels that, historically, have never ended peacefully. The S&P 500 currently trades at around 28 times its earnings. That means investors are willing to pay $28 for every $1 of profit the average company produces. For more than a century, the normal range has been closer to 15 to 17. Whenever valuations have stayed far above that band, the rules of gravity eventually reasserted themselves. This kind of overvaluation has appeared only twice in the last 100 years. Once in 1929, on the eve of the Great Depression. Once in 2000, at the peak of the dot-com mania, before the Nasdaq lost nearly 80% of its value. Both times, people said the same words. This time is different. Both times, it was not. But 2025 adds a new ingredient that neither 1929 nor 2000 had at this scale: extreme concentration. 7 companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla now account for roughly 30% of the entire S&P 500's value. In other words, almost one-third of the diversified U.S. stock market hangs on the fortunes of 7 names. If those pillars wobble, the whole structure shakes. We've seen echoes of this before. In 1929, a small cluster of industrial and utility stocks carried the indexes higher even as the broader market weakened. In 2000, a narrow slice of tech and telecom names did the same. But in those eras, the dominant stocks still represented a smaller slice of the pie than today's Magnificent Seven. The concentration now is sharper, more fragile, and wired into passive investing, algorithmic trading, and retirement accounts in ways the 1920s speculators couldn't have imagined. Nvidia is the poster child of this moment. Its shares trade at more than 65 times earnings, meaning every dollar of profit is being valued at over $65 in the stock market. The company's market value has swelled past $3 trillion, more than the entire stock market of Germany, the 4th largest economy on Earth. Does that make Nvidia a historic innovator? Perhaps. But markets don't just price innovation. They also price dreams, hype, and fear of missing out. In 1999, investors were right that the internet would reshape the world. They were completely wrong about what that meant for the price of Pets.com and dozens of other now forgotten names. Being right about the technology does not protect you from being catastrophically early on the stock. Today, artificial intelligence has taken the internet's place as the magic word that justifies any valuation. Companies bolt AI onto a product and watch their share prices pop. Commentators talk about the end of business cycles, the birth of a new era of productivity, and the inevitability of higher and higher markets. If that sounds familiar, it should. It's the same melody that played in 1929 and 2000, just with new instruments. The second bubble is more quiet, more personal, and for many families, more dangerous: real estate. On paper, the 2008 housing crash was supposed to be the wake-up call that prevented this from happening again. Regulators swore things would be different. Lenders raised standards. The phrase subprime mortgage became a curse. Yet the core dynamic, home prices disconnecting from what ordinary people can reasonably pay, has returned, just in a subtler costume. Measured against incomes and rents, U.S. home prices in late 2025 sit roughly 50% above their long-term trend. At the peak of the mid-2000s bubble, that figure was about 35%. In other words, the current overvaluation is roughly 43% larger than the madness that nearly took down the global banking system. The difference is that this time people have lived with expensive housing for so long that it feels normal. They assume prices only go one way, and that any dip is a buying opportunity. We've heard that line before. Looking at averages, though, understates another brewing disaster: commercial real estate. The skyscrapers and office parks that once symbolized economic might are now quietly bleeding out. Remote work and hybrid schedules didn't just change commutes. They changed the math behind trillion-dollar assets. In many American cities, office towers sit almost half empty. In San Francisco, vacancy rates north of 30% are becoming the rule, not the exception. These buildings were financed during an era of near-zero interest rates, when 3% loans felt almost permanent. Those loans do not last forever. As they mature, landlords must refinance at 7, 8, even 9% interest. Imagine a building that was barely profitable at 3% suddenly having to pay 2 or 3 times as much interest. Rents aren't high enough. Tenants aren't numerous enough. The numbers simply don't work. When numbers stop working, reality eventually catches up. owners start handing the keys back to lenders. Lenders, often regional banks, suddenly own half-empty buildings worth far less than the loan balance. What began as a slow leak turns into a rapid repricing. This is how a commercial problem transforms into a banking problem, just as subprime mortgages did in 2008. Only this time, it's office towers in New York, Chicago, and San Francisco instead of subdivisions in Arizona and Florida. The third bubble is the one that makes 2025 truly different: government bonds. For more than a century, bonds have been the place you flee to when everything else burns. In 1929, Treasury bonds protected capital even as stocks plunged almost 90%. In 2008, U.S. government debt became the ultimate safe haven as investors dumped risky assets and rushed into T-bills and long-term treasuries. But safety has a price, and that price has been rising. The United States now carries over $36 trillion in federal debt, roughly 125% of its annual economic output. After World War II, America briefly had a similar debt ratio, but back then it was the only major industrial power whose factories were still standing. Today, it faces real competition from countries with better demographics, lower debt burdens, and growing manufacturing bases. The old argument, "we can always borrow more because we're the safest game in town," sounds less convincing when everyone can see the balance sheet. Servicing this mountain of debt already costs more than $1.2 trillion a year, more than the country spends on its military or Social Security. At this scale, interest payments are not just another line in the budget, they are the budget. And when interest consumes everything, a government is pinned into a three-way corner. It can slash spending sharply, which triggers recession and political backlash. It can hike taxes sharply, which also triggers recession and political backlash. Or it can quietly allow inflation to erode the value of the debt, turning bondholders into the real bag holders. None of these paths leads back to the placid world where bonds gently cushion stock market falls. When interest rates rise to entice buyers, existing bonds fall in price. When the government issues more debt to cover old interest, it pushes yields up further. In that environment, the thing that was supposed to be safe becomes another source of loss. Put these three realities together: stocks priced for perfection and concentrated in a handful of giants, housing and commercial real estate stretched beyond the levels that preceded 2008, and a bond market strained by debt loads that would have stunned earlier generations, and you begin to see why some analysts call this the everything bubble. It is not one fire to be contained. It is a forest so dry that any spark can turn into an inferno. And just like in 1929 and 2008, the most dangerous belief is the oldest one in finance, that this time will somehow be different. If all of this sounds abstract, rewind the tape to 1929 and watch how a similar story played out in slow motion. In the late 1920s, valuations reached levels that old-school bankers had never seen. The Dow Jones traded at more than 30 times earnings, a staggering multiple for its time. Newspapers celebrated a new era where mass production, electricity, radio, and automobiles had supposedly rewritten the rules of economics. Commentators insisted that the world had entered a permanent boom and that any concern about high prices was outdated thinking. The phrase on everyone's lips was simple and deadly: "This time is different." It wasn't just valuations, it was how people were buying those stocks. Margin debt, borrowing money from brokers to buy shares, exploded. Barbers, doctors, factory workers, even teenagers were speculating with borrowed money. They put down a small deposit and controlled a large position, convinced the market could only go up. For a while, it worked. Fortunes were made in months. Stories of ordinary people becoming rich pulled more and more into the game until leverage was baked into the entire system. The parallels with our present moment are uncomfortable. In 2025, margin debt relative to the size of the economy has again reached extreme levels. But margin accounts are only the part we can see clearly. Modern leverage hides in option contracts, structured products, and corporate balance sheets. Retail traders buy weekly call options instead of stocks, magnifying both gains and losses. Others quietly load up credit cards to buy the dip, betting that stocks will bounce before the bills come due. Corporations borrow at low rates not to build new factories or hire more workers, but to buy back their own shares, pushing prices higher and making earnings per share look better. Leverage isn't just in the brokerage statement anymore. It's woven into the plumbing of the system. Inequality followed a similar script. In 1929, the top 1% of Americans controlled roughly a quarter of all income. That kind of concentration made the economy extremely sensitive to the behavior of a small elite. When wealthy investors cut spending and pulled back after the crash, demand vanished and the spiral deepened. Today, inequality has climbed even further. The top 1% now controls roughly a third of all wealth, and the top 10% drives the majority of consumer spending. That means the entire structure of the economy rests on a narrow platform of asset prices and wealthy confidence. If their portfolios fall sharply, the shock doesn't just hit Wall Street. It ripples through car dealerships, restaurants, travel, and every main street that depends on affluent customers. Yet there is one crucial difference that makes the coming storm even more personal than 1929. Back then, fewer than 10% of American households owned stocks. When the market crashed, people were devastated by the unemployment and deflation that followed, but most did not watch a brokerage account vaporize in real time. Today, roughly 58% of households are tied to the market through direct holdings or retirement accounts like 401ks and IRAs. Millions of ordinary workers who never think of themselves as investors are in fact fully exposed. When indexes fall, their future falls with them. There is no wall between Wall Street and the living room anymore. You might argue that we're safer now because we have safeguards the 1920s never knew. FDIC insurance, a more sophisticated central bank, decades of experience fighting crises. That protection is real, but it's not unlimited. The Federal Deposit Insurance Corporation promises to protect deposits up to $250,000 per account, but its insurance fund holds barely a fraction of the money it insures. Think of a small umbrella trying to cover an entire stadium. As long as only one section gets rain, it works. When the whole sky opens up, it doesn't. If multiple large banks fail at once, the FDIC would burn through its reserves in days. The only way to keep the promise would be for the government and the Federal Reserve to create new money on an enormous scale, effectively socializing losses through inflation. In that scenario, depositors might get their nominal dollars back, but those dollars would buy much less. Either you lose your savings outright through default, or you lose their value slowly through rising prices. The poison is different, the result is the same. The Federal Reserve has changed roles over the last century. In 1929, it was a young institution, still learning its powers and limits. It made catastrophic errors by tightening policy and allowing banks to fail. But it had one important asset. The public still believed in the dollar. There was room to make mistakes and learn. By 2008, the Fed had become the firefighter-in-chief, slashing rates and launching quantitative easing to douse the flames of the mortgage crisis. It was applauded for averting a second Great Depression, even if the water used to put out that fire ended up flooding the foundations for the next bubble. From 2008 to the early 2020s, the Fed kept interest rates pinned near zero and injected trillions into financial markets. It propped up asset prices again in 2020 when the world shut down, expanding its balance sheet to a size that previous generations of central bankers would have considered unthinkable. The medicine worked, temporarily, but every dose required a larger injection, and the side effects became harder to ignore. The inflation wave of 2021-2023
with prices jumping at the fastest pace in 40 years, was a harsh reminder that money is not free, and consequences can be delayed, not erased. That's where the trap lies today. If a new crisis hits in 2025 or 2026, the Fed cannot replay the 2008 script without facing immediate backlash from the bond market, foreign creditors, and ordinary citizens already exhausted by higher living costs. Cut rates aggressively and markets will cheer, but inflation will likely roar back. Keep rates high to defend the currency and bondholders, and the financial system will seize up as debts become unpayable. The tools that once looked like magical levers of control now look more like emergency measures that have been used too often, dulling their power and eroding trust. If 1929 teaches us how bubbles burst, and 2008 shows how modern financial engineering can infect the entire globe, then 2025 sits at the crossing of those two roads. To see that intersection clearly, we need to move from the Great Depression to the Great Recession and examine how the last rescue operation set the stage for the next disaster, and why the lifeboats that saved us then may not float this time. The last great warning sign before our current moment was 2008. That crisis didn't begin with a headline or a single dramatic crash. It began with millions of quiet signatures on mortgage documents that never should have been approved. Subprime borrowers, people with weak credit, unstable income, or no proof of either, were handed loans with low teaser rates and promises that rising home prices would take care of everything. Those mortgages were sliced into complex securities, stamped with investment-grade ratings, and sold around the world to pension funds, banks, and governments that believed they were buying safety. On the surface, the risk looked diversified. Underneath, it was the same rotten asset, repeated millions of times. For a while, the machine worked. As long as house prices kept rising, borrowers could refinance, lenders collected fees, and Wall Street dressed up the entire structure as innovation. But when prices stopped climbing, a simple truth reasserted itself. People who can't afford their loans eventually stop paying. Defaults began at the margins and then spread inward, revealing that major institutions were leveraged 30-to-1, holding mountains of mortgage-backed securities that weren't worth the paper they were printed on. When a small drop in housing prices rippled through those balance sheets, titans like Lehman Brothers imploded almost overnight. Back then, the leverage was concentrated, mostly in housing, mostly in mortgage derivatives, mostly on the books of large financial institutions. That concentration was dangerous, but it was also knowable. Policymakers could identify the epicenter and design targeted rescue operations. Today, the danger is more diffuse. Subprime lending hasn't disappeared, it has metastasized. It lives in 84-month auto loans handed to buyers who can barely afford the first payment. It lives in record credit card balances with interest rates north of 20%, quietly compounding in the background of everyday life. It lives in $1.7 trillion of student debt that many borrowers will never completely repay, turning what was sold as an investment in the future into a chain around their ankles.
Corporate America has joined the party. Since 2008, total corporate debt has ballooned from roughly $2 trillion to over $10 trillion as companies borrowed aggressively when money was cheap. Much of that borrowing didn't go into new factories or research. It went into stock buybacks that inflated share prices and executive compensation. The entire system is now dependent on the assumption that funding will always be available at low rates. When that assumption breaks, the balance sheet tricks will too. Hovering over all of this is a derivatives market whose notional value is estimated in the hundreds of trillions of dollars, roughly 10 times global GDP. Most of these contracts are interest rate swaps and credit default swaps, invisible to ordinary investors but crucial to the plumbing of modern finance. When interest rates move sharply or major borrowers begin to fail, Those derivatives don't just sit still, they reprice violently. The same interconnectedness that was supposed to distribute risk ends up transmitting stress at the speed of light. One institution's loss becomes another's margin call, which becomes someone else's default, and so on. In 2008, the Federal Reserve still had powerful ammunition. When the crisis hit, short-term interest rates stood above 5%, giving the Fed room to cut all the way to zero. Those cuts, combined with emergency lending programs and the first rounds of quantitative easing, flooded the system with liquidity. The Fed's balance sheet swelled from under $1 trillion to around $4 trillion in just a few years. The message to markets was clear. No matter how reckless the behavior had been, the central bank would stand behind the system. Moral hazard, rewarding risk by cushioning failure, was the price policymakers were willing to pay to avoid a depression. Today, that path is far narrower. After more than a decade of near-zero rates and multiple rounds of QE, the Fed enters the 2025-2026 window with rates much lower than in 2007 and a balance sheet already above $7 trillion. The experiment of creating money on such a scale has already produced a harsh result: the inflation shock of 2021-2023, when the cost of food, rent, and energy surged at the fastest pace in a generation. People haven't forgotten, nor have global creditors. Any attempt to unleash another unlimited wave of money printing will be seen not as a clever rescue, but as confirmation that the currency itself is being sacrificed. The federal government is equally constrained. In 2008, public debt stood at about 2/3 of GDP. That was high but manageable, giving Washington room to approve programs like TARP and a series of emergency guarantees that ultimately added up to roughly $2 trillion in support. It was politically painful, but financially feasible. The rest of the world still considered U.S. debt the ultimate safe asset. By 2025, that margin of safety has vanished. Federal debt sits around 125% of GDP, with trillion-dollar deficits projected as far as the eye can see. Interest payments alone have swollen into the largest single line item in the federal budget, surpassing defense and Social Security. In plain language, the government is now borrowing to pay the interest on previous borrowing, a dynamic that every household recognizes as unsustainable. Trying to repeat the 2008 bailouts in this environment would mean either borrowing at much higher interest rates, which would accelerate the problem, or pressuring the Fed to print the difference, which would tear at the currency's value. The toolbox looks the same as in 2008, but every tool is rusted from overuse. The international backdrop has also turned from supportive to fragile. During the Great Recession, China was still in its rapid growth phase. Beijing unleashed a massive stimulus, pouring money into infrastructure and construction, which helped pull demand for commodities and manufactured goods back from the edge. Europe, for all its internal problems, still had room on its balance sheet and enough political cohesion to coordinate responses with the United States and other G20 countries. Globalization, for all its critics, provided a framework for joint action. The world of 2025 is different. China faces its own intertwined crises: a bloated property sector, local governments drowning in hidden debt, and a shrinking population that challenges its long-term growth model. Europe wrestles with energy volatility, aging demographics, and political fragmentation. Rather than a group of strong economies coordinating stimulus, we see a collection of weakened players, each fighting its own fire. Add to this a backdrop of war in Ukraine, conflicts in the Middle East, and rising tension over Taiwan, and the odds of calm, global cooperation in the face of a financial shock drop sharply. Meanwhile, the warning lights on the dashboard are already blinking. The yield curve, the relationship between short-term and long-term interest rates, has been one of the most reliable recession indicators for 70 years. When short rates move above long rates, the curve inverts, signaling that markets expect trouble ahead.
Every recession since 1950 has been preceded by such an inversion, with no false alarms. The curve inverted in mid-2022 and stayed that way for more than 2 years before finally normalizing in late 2024. Historically, the recession doesn't arrive during the inversion. It arrives 3 to 12 months after the curve uninverts. That timing places the danger window squarely between late 2024 and late 2025, the exact period when other stresses are building. Consumer debt tells a similar story. Credit card balances have hit record highs, with average households carrying thousands of dollars at interest rates that now rival payday loans. Delinquencies, especially among younger and lower-income borrowers, are climbing back to levels last seen in the aftermath of the 2008 crisis. Because consumer spending accounts for roughly 2/3 of U.S. GDP, maxed-out credit cards and rising defaults aren't just a personal problem. They're a direct threat to the entire economy's engine. And in the background, a slow-motion disaster is unfolding in commercial real estate. Office towers financed at 3% are rolling over into a world of 7% to 9% refinancing rates. Vacancy rates in some downtowns have reached levels that would have been unimaginable a decade ago. Properties are worth 40% less than the loans that funded them. Over $2 trillion of commercial mortgages come due across 2025. The math does not work. Owners will walk away, handing the keys to lenders. Those lenders are often regional banks whose balance sheets are heavily concentrated in local real estate. We've already seen early tremors, the failures of Silicon Valley Bank, Signature Bank, and First Republic in 2023, the distress at New York Community Bank in 2024. Those happened in relatively calm economic weather. Imagine the same institutions facing a full-blown recession and a tidal wave of commercial defaults. Put all of this together, and you don't get a tidy forecast. You get a loaded system waiting for a trigger. It might be an earnings miss from a major tech company, a sudden jump in bond yields, a geopolitical shock, or a messy fight over the federal debt ceiling. The specific spark is unpredictable. What is predictable is how a system this fragile responds when any spark lands. And that is where we turn next, to the mechanics of the cascade itself, how a single crack in the facade can turn into the kind of crash that doesn't just rattle markets for a few months, but rewrites the financial lives of an entire generation. The cascade never begins with a headline that says, "This is it." It begins with something that looks at first glance manageable.
Maybe NVIDIA or another member of the Magnificent Seven misses earnings by a few percentage points, or gives guidance that is just a little less euphoric than Wall Street hoped. Maybe a regional bank in the wrong city reveals a hole in its balance sheet that is larger than expected. Maybe a missile lands in the wrong place in an already unstable region, or a negotiation over the U.S. debt ceiling goes badly off script. In a healthy system, any one of these moments would cause volatility, then be absorbed. In a system as stretched as ours, they function like a spark landing in a forest of dry tinder. The first reaction is algorithmic. Trading systems wired into exchanges look not at the story, but at the numbers. Earnings versus expectations, price action versus trend, volatility versus thresholds. When those numbers flip from green to red, the machines sell. A stock like NVIDIA, priced for perfection after years of AI euphoria, doesn't drift gently lower. It can gap down 10 or 15% in a single session. Because it now represents a massive share of the major indices, that one stock pulls the S&P 500 down automatically, even before human emotions join the move. What was a story about AI changing the world suddenly looks, on the chart, like a cliff. Then the psychology shifts. If the AI narrative starts to crack, If investors begin to question not the technology, but the prices they've been willing to pay, the doubt spreads. Microsoft, Apple, Amazon, Alphabet, Meta, Tesla, all of them have been riding the same wave of belief that this time is different. When one pillar falls, the others start to shake. Within days, the Magnificent Seven could be down 20 or 30% as a group, dragging the entire index 6 to 9% lower. On financial television, the language will still be calm: healthy correction, profit-taking, rebalancing. Underneath, the gears that turn a correction into a crash will already be moving. Those gears are called margin calls. For years, investors have been encouraged to put their money to work by borrowing against their portfolios. When prices are rising, leverage feels like genius. You make gains not just on your own capital, but on the borrowed portion as well. But debt doesn't disappear when markets turn. As soon as stocks fall far enough, brokers begin to demand more collateral. If the investor can't post fresh cash, the broker sells the assets automatically to protect the loan. That forced selling pushes prices lower, which triggers more margin calls for other investors, which triggers more forced selling. In 1929, that feedback loop turned a sharp drop into an 89% collapse. In 2025, with leverage embedded not just in margin accounts, but in options trades, structured products, and risk parity funds, the same dynamic will play out on a much more complex stage, but with the same brutal logic. At the same time, institutional investors, pension funds, endowments, insurance companies, sovereign wealth funds, are not relying on gut instinct. They are governed by risk models and hard rules. When volatility crosses certain thresholds or losses exceed preset limits, those models require them to cut exposure. It doesn't matter what the chief investment officer believes about the long run, the system is designed to sell to survive. As prices fall 20%, then 25%, then 30%, more and more of these automatic de-risking processes switch on. Selling begets selling until the screen looks less like a market and more like an elevator shaft. Once stocks have fallen far enough, panic begins to search for a safe harbor. In past crises, that harbor was the U.S. Treasury market. Investors dumped equities and bought government bonds, driving yields down and prices up. In 1929, bonds cushioned the blow. In 2008, they offered a genuine refuge. But in the mid-2020s, the safe asset is itself under strain. The federal government must roll over trillions in existing debt and finance fresh deficits that are already enormous before any recession-driven shortfall. If a flight to safety hits at the same time that the Treasury is trying to sell record volumes of bonds, yields don't fall, they spike. The mechanism designed to provide shelter becomes part of the storm. This is the doom loop. Higher interest rates raise the government's interest bill, which expands the deficit, which forces more borrowing, which requires more bond issuance, which pushes yields even higher. Countries that enter this spiral rarely exit without either defaulting outright or inflating their currency to escape in nominal terms. For a small emerging economy, this story is sadly familiar. For the issuer of the global reserve currency, it would mark the end of an era. While this is unfolding in financial markets, the housing sector quietly passes from euphoria to paralysis. At first, home sellers refuse to believe prices are really falling. They simply pull listings or wait for a better market. Buyers facing higher mortgage rates and shaken portfolios step back. Transactions dry up. Months of inventory creep higher. Eventually, life intervenes. People divorce, change jobs, run into financial trouble. They have to sell, and the only way to sell in a frozen market is to cut price. Each forced sale creates a new, lower comparable that appraisers and lenders use to value other homes. A neighborhood that thought it was down 5% discovers it is really down 20%.
Over the course of a year, in the most inflated cities, declines of 40 to 50% are no longer hypothetical. They are printed on closing statements. For anyone who bought in the final years of the boom with low down payments, this means negative equity. They owe more on their mortgage than their house is worth. Selling becomes impossible without writing a check at the closing table. Many will cling on, hoping for a rebound. Others, especially investors who bought multiple properties, will simply walk away, mailing the keys to the bank and treating the loan as a business loss. Each default feeds back into the banking system as a realized hit, just as subprime defaults did in 2008, only this time it's layered on top of the commercial real estate wreckage already in motion. In downtowns across the country, office towers quietly become financial time bombs. As leases expire and tenants shrink their footprints, cash flows that once supported billion-dollar properties shrink to a trickle. Owners, staring at refinance terms that assume 7 or 8% interest on buildings that are half empty, make a rational calculation. Continuing to feed the loan makes no sense. They stop paying. The lender takes the building back and has to mark the asset from a fictional value on the books to a harsh reality in the market. When enough of those write-downs pile up, bank capital ratios fall below regulatory minimums. That is when regulators step in, declare institutions insolvent, and close the doors. In the last banking crisis, from 2008 to 2012, 465 banks failed over 5 years. This time, the concentration in regional and community banks, heavily exposed to local commercial real estate, makes a similar or larger wave of failures possible in a shorter window. And unlike in 1930, bank runs no longer require lines of anxious depositors wrapping around the block. A rumor on social media, a concerning headline, or a viral screenshot of a balance sheet can push thousands of people to open an app and move their money in minutes. Silicon Valley Bank's collapse in 2023 showed how a digital-age bank run can drain tens of billions in deposits almost overnight. Scale that behavior across dozens of institutions during a recession, and the pressure becomes existential. The FDIC insurance fund, which sounds reassuring on paper, is tiny compared to the potential losses.
With roughly $125 billion standing behind more than $10 trillion in insured deposits, the math doesn't work if multiple big banks fail. To truly make depositors whole, the government would have to backstop the fund with freshly created money, once again raising the specter of inflation and currency debasement. The supposed cure, printing, begins to look suspiciously like a different kind of disease. Behind these numbers, charts, and cascades, there are real people, real families, and real futures. And to understand the true cost of a crash that shatters the records of 1929 and 2008, we have to step away from the trading floor and into the living rooms, retirement offices, and cramped apartments where the impact will actually be felt. For an ordinary American, this story does not begin with bond auctions or yield curves. It begins with a number on a screen, a 401k, a 403b, an IRA that they have watched quietly and dutifully for decades. They did what the system asked of them. They worked, they contributed, they trusted the charts that showed over the long run, markets always go up. They believed that if they just stayed the course, they would be fine. And then, over a few violent months, that number falls 60 or 70%. $600,000 becomes $200,000. A lifetime of discipline is reduced to something that no longer looks like retirement. It looks like a delay, a compromise, a life rewritten. On a spreadsheet, this is a drawdown. In a human life, it is grief. It's a 58-year-old quietly realizing they may have to work until 70 if they can keep their job. It's a 72-year-old on a fixed income being forced to sell stocks at the bottom just to pay for rent, medication, and groceries, locking in losses they will never live long enough to recover. In 2008, many who simply held on eventually got back to even within 5.5 years. It was painful,
But the recovery came within the span of a working life. This time, the timeline may not be so forgiving. Japan's stock market took 34 years to regain its 1990 peak. An entire generation of Japanese savers retired and died before their portfolios ever recovered. A similar path for America would not just be an economic event, it would be a generational trauma. Housing, which has been sold to Americans as the safest path to wealth, becomes another trap. Millions who bought homes at peak prices with low-rate mortgages suddenly find the value of those homes slashed by 30, 40, even 50%. They can't sell without taking a loss. They can't refinance on better terms. They're stuck. The home that was supposed to be an asset becomes an anchor, tying them to cities with no jobs, markets with no buyers, and neighborhoods hollowed out by foreclosure signs and empty storefronts. Geographic mobility, a key safety valve in past downturns, shrinks. People stay where they are, not because they want to, but because they can't afford not to. The economy becomes less dynamic, less able to adapt, at exactly the moment it needs flexibility most. For young people, the timing is cruelest of all. The class of 2026 or 2027 walks across the graduation stage into an economy that is shutting its doors. The internships that were supposed to turn into jobs have vanished. Entry-level roles are frozen. Companies that once boasted about investing in the next generation of talent now speak in the language of restructuring, right-sizing, and hiring freezes. Each job posting attracts hundreds of applicants. Many graduates take whatever they can find: underpaid gig work, unrelated service jobs, temporary contracts, just to keep moving. Economists have tracked what happens when you begin your working life in a deep recession. On average, your earnings are depressed not just for a year or two, but across your entire career. You never quite catch up to the cohort that graduated a few years earlier.
The lost income is not just a statistic. It is a house not bought, a family started later, savings that never had time to compound. Layered on top of this is a student debt burden that, for millions, already feels impossible in good times. When payments resume or rise in the middle of a downturn, many borrowers simply stop pretending. They understand at some level that they will never pay it all back. They triage. Rent, food, electricity, maybe car payments. Those come first. The loan servicer comes last. Defaults quietly climb. What should have been a ticket into the middle class becomes a chain that keeps a generation from ever fully getting there. The very people who were supposed to drive future consumption and innovation are instead sending every spare dollar into a black hole of old obligations. As the recession deepens, layoffs move up the income ladder. It starts with temporary workers, then spreads to full-time employees. Tech companies that once bragged about hiring the best and the brightest announce 15% cuts. Financial firms exposed to market declines trim staff. Retailers shut stores. Restaurants close. A feedback loop develops. People who lose jobs cut spending, which hurts businesses, which lay off more workers, which cuts spending further. The official unemployment rate climbs from 4% to 7 or 8% within months, then pushes into double digits. In boardrooms and policy circles, it's a necessary adjustment. In living rooms, it's a paycheck gone, a move back in with parents, a retirement delayed, a dream postponed indefinitely. The Federal Reserve sits at the center of this storm, with a set of tools that once seemed omnipotent and now look blunt, exhausted, and dangerous. If the Fed slashes interest rates back towards zero and launches another round of quantitative easing, markets might stabilize for a time. But everyone remembers 2021 to 2023, when inflation hit levels not seen in 40 years, and the cost of essentials exploded. Trust in printed money is thinner now. Another massive wave of money creation would be read not as heroic rescue, but as confirmation that the currency itself is being sacrificed. If instead, the Fed chooses to hold the line, to prioritize price stability and avoid another inflation shock,
Then it must tolerate mass unemployment and a drawn-out deleveraging that feels for ordinary people like a depression. There is no painless door left to walk through. Every option is a trade-off between kinds of suffering. The federal government faces a similar trap. In 2008, with debt at 67% of GDP, it could borrow trillions to shore up banks, stabilize key industries, and stimulate demand. Today, with debt already at 125% of GDP, the room to maneuver is gone. Another multi-trillion-dollar bailout package would force bond investors to question whether the United States can or will ever bring its finances back under control. If they demand higher yields as compensation, the interest bill grows even faster, pushing the country deeper into the doom loop. The bailout playbook that saved the system 15 years ago is now the very thing that could break it. Globally, there is no obvious savior waiting off stage. In 2008, China's rapid growth and massive stimulus helped pull commodity producers and exporters out of the abyss. Europe, while damaged, was still capable of coordinated action. In the mid-2020s, China is facing its own property bust, local government debt crisis, and demographic decline. Europe is wrestling with energy insecurity, political fragmentation, and aging populations. Emerging markets are strained by dollar debt and volatile capital flows. Geopolitical tensions, from Ukraine to the Middle East to the Taiwan Strait, are not background noise. They are sources of real risk to food, energy, and supply chains. In 2008, leaders at least tried to row in the same direction.
In the next crisis, every major power is more likely to protect itself first and worry about everyone else later. In that environment, trust becomes the most valuable and the most fragile asset of all. Trust that banks will be there when you need your savings. Trust that pensions will pay out what they promised. Trust that the dollars you earn today will buy something close to the same amount of goods a few years from now. When markets crash, when headlines scream, when people watch neighbors lose homes or jobs or businesses, that trust erodes. And once trust in institutions is broken, it is far harder to rebuild than a balance sheet. It would be comforting to tell ourselves that this is all an unlucky accident, a perfect storm that no one could have seen coming. But that would be another illusion. The system we have built is not an act of nature. It is the sum of thousands of deliberate choices made over decades. Choices to paper over each crisis with more debt, instead of accepting short-term pain. Choices to reward speculation more than productive investment. Choices to treat rising asset prices as proof of intelligence rather than signs of accumulating risk. Each decision made sense in the moment, especially to those who benefited. Together, they created a structure where a reckoning was not just possible, but inevitable. The real question, then, is not whether a crash in 2025 or 2026 will hurt. It will. The question is what we learn from it. Do we spend the next decade trying to reinflate the same bubbles, hoping that if we can just get back to the old highs, everything will feel normal again? Or do we accept that the era of easy money, ever-rising leverage, and perpetual bailouts was a historical anomaly, not a birthright? Do we continue to believe that this time is different? Or do we finally recognize that the pattern we keep repeating is not an accident, but a mirror? The people who lived through 1929, through 1970s stagflation, through 2008, all believed at some point that the world they knew was permanent, until it wasn't. The generation that faces the next great crash will have to live with its consequences long after the headlines fade. Their wealth, their careers, their faith in institutions will be shaped by how honestly we confront the causes, not just the symptoms of this crisis. History does not repeat itself mechanically, but it does rhyme with unnerving precision. For nearly 6 centuries, reserve currencies and dominant economies have followed the same arc: rise,
overreach, debasement, decline. Each believed in its own exceptionality. Each thought the pattern would spare them. It never did. The record-shattering crash that looms ahead is not just about numbers on charts. It is about whether we finally recognize that pattern while there is still time to change course, or whether we watch again as an entire era ends and only understand what happened years later when it is far too late to do anything about it.